Why are fintech startup salaries lower than traditional finance? Imagine a landscape where innovation is rapidly reshaping how we handle money. Yet the rewards for those pioneering these changes are often less lucrative than in established financial institutions. This contrast prompts a closer look at the underlying reasons behind salary disparities between fintech startups and traditional finance firms. One key factor is the stage of development and financial stability. Fintech startups are typically in early phases of growth, often relying heavily on venture capital funding or angel investments. These sources of capital are usually allocated toward product development, customer acquisition, and market expansion rather than high employee compensation. As a result, salary budgets tend to be more conservative compared to well-established banks or investment firms that have steady revenue streams and larger profit margins. Another aspect is the revenue model and profitability. Traditional financial institutions have long-standing, diversified revenue streams from services such as asset management, retail banking, and trading commissions. These established income sources allow them to offer higher salaries and benefits to attract top talent. Conversely, many fintech startups operate on a model focused on rapid growth and market share expansion, often prioritizing user acquisition over immediate profitability. This approach means they have less financial flexibility to match the compensation levels of traditional firms. The risk profile also plays a significant role. Working at a startup involves higher uncertainty, including the possibility of failure or significant restructuring. Employees may accept lower salaries in exchange for equity options or the potential for future financial gains if the company succeeds. In contrast, traditional finance firms tend to offer more stable employment and predictable compensation packages, which can translate into higher salaries. Furthermore, the scale and operational costs differ substantially. Large financial institutions benefit from economies of scale, allowing them to distribute profits across a broad workforce and invest in competitive compensation packages. Fintech startups, often operating with lean teams and limited resources, may not have the same capacity to pay premium salaries. Lastly, the talent pool and experience levels can influence salary differences. Traditional finance often attracts professionals with extensive experience and specialized skills, which command higher pay. Fintech startups frequently hire a mix of experienced professionals and younger talent eager to learn and grow, often at lower salary levels initially. In summary, the lower salaries in fintech startups compared to traditional finance are primarily driven by their early-stage financial constraints, revenue models focused on growth rather than profit, higher risk exposure, operational scale, and the composition of their workforce. As these companies mature and achieve profitability, salary levels may increase, but the current landscape reflects the unique challenges and opportunities within the fintech sector.